So the IRS just announced 2026 retirement limits. 2026 includes increases for 401ks, IRAs, and catch-up contributions. Now, these changes will affect workers, savers, and retirees. And we'll talk about the changes, but we'll also talk about how to maximize your retirement contributions later in the video. So, first, we need to start with what a contribution limit actually is. It's the maximum you can put into a tax-preferred account each year. Higher limits equals greater tax shelters. Lower limits equals less room for long-term gains. So the IRS actually adjusts these annually to keep up with inflation. So starting with 401ks, 403bs, 457, TSPs, right? These are the main workplace contributions, and these limits rise to $24,500. This is up from $23,500 in 2025. Now, workers 50 plus can add $8,000 of catch-up contributions. So the total potential for ages 50 plus is actually $32,500 as we go into 2026. Now we need to talk about Roth catch-up wage thresholds. This is actually new for 2026. You see, Roth catch-ups return in 2026, but only for high earners. What are these thresholds? Well, in 2025, we had none, but in 2026, the threshold here would be $150,000. Now, this applies to workers 50 plus making catch-up contributions. So if you earn over $150,000, your catch-up must be in a Roth. You cannot do pre-tax anymore. If you earn below $150,000, you can choose pre-tax or Roth, is your decision. Next, we have IRA contribution limits. These limits rise to $7,500 in 2026. This is up from $7,000 in 2025 and applies to traditional and Roth IRAs. Now, this means more room for tax-deferred or tax-free growth, whether you choose traditional or IRA. Now, with IRAs, we have to talk about the catch-up contributions for those age 50 plus. The catch-up moves to $1,100. This is up $100 from $1,000 in 2025. Now, there are annual COLA adjustments added by Secure 2.0. So the total possible for ages 50 plus is $8,600. Now, there are deduction phase-outs, and these phase-outs rise in 2026 across all filing statuses. For singles with workplace plans, that deduction phase-out is between $81,000 and $91,000. Now, for married filing jointly covered by a spouse, your deduction phase-out is between $129,000 and $149,000. And for Roth IRAs, you don't get a deduction, but your eligibility phases out between $153,000 and $168,000 if filing single, and $242,000 and $252,000 if married filing jointly. Now, for those a little bit older, ages 60 to 63, you get a boost here. You keep a higher catch-up of $11,250. Now, it's the same as 2025, but it's still much stronger than the $8,000 baseline. This applies to 401ks, 403bs, 457s, and TSPs. And it's designed for peak earning years, right? They assume that in these ages, you'll be making the most you've ever made. So they want you to catch up even faster if possible. Now, onto the savers credits. The limits rise for low and middle income savers. For married filing jointly, the limit is now $80,500. For head of household, it is now $60,375. And for single or married filing single, the limit is now $40,250. This is huge for those who want to take the savers credit. So let's recap the contribution limits here. As we saw, 2026 brought higher limits across almost every plan. 401k contribution limits are now $24,500. IRAs are now $7,500. Catch-up contributions are $8,000 for 50 plus or $11,250 between ages 60 and 63. Now, we saw Roth and IRA phase-outs widen to give people a greater chance to contribute. Now let's move on to how you maximize your retirement contribution. And something that you need to know is that every tax advantage plan uses 3 levers. First is the contribution limit, which is how much you put in, the account type, which is pre-tax, Roth, or mixed, and the age window, which is regular versus catch up. So how do you actually maximize these limits? Well, you want to use this order if you can't max out everything. First, get full employer match. Second, fund your Roth or traditional IRA. Third, add extra to your 401ks, 403bs, or 457s if you can. Next, if you're 50 and above, add that catch up. And if you're between 60 and 63, add the Secure 2.0 catch up. So let's walk through an example of a 52-year-old worker here with higher limits significantly impacting the increased capacity that they have. So for a regular 401k, they can max it out at $24,500. They can catch up with the $8,000 additional contribution for a total of $32,500 possibly, with the IRA plus catch up of $8,600. Now, there are some pitfalls that I want you to be aware of here, so let's go through them. Pitfall number 1 is overestimating what you can save. You see, most Americans actually cannot max out these limits. In fact, 42% report no disposable income after essentials, and only 14% maxed out a 401k in 2024. Many savers are older or either higher income, but most people are not able to max this out. The next pitfall here is ignoring inflation erosion. You see, higher limits don't erase higher living costs. So saving more may only maintain purchasing power, not give you any additional benefit. And real retirement security still lags behind true inflation. So the fix here would be to adjust your savings rate yearly to match inflation. Now, pitfall number 3 is not using catch-ups. Catch-ups are the strongest late career tool to boost your retirement. You see, many workers forget or delay using them, and missing 1 year creates a permanent loss. So you want to contribute every single year you can. So the fix here is to schedule auto increases so you don't miss a year. Now, here's a decision tree, right? What should you do in 2026? First, ask yourself, can you get full employer match? If yes, you want to do it. Are you eligible for Roth IRAs? If yes, fund it. Are you over the age of 50? If yes, use catch-ups. Are you between age 60 and 63? If yes, check higher secure limits. And if your cash is tight, focus on match, okay? So the final checklist for 2026 is this. Use this before updating your plan. Confirm your eligibility. Know your phase-out ranges. Use catch-ups at 50 plus. Use Secure 2.0 at between ages 60 and 63. Automate contributions. And if 3+ items are missing, I want you to update your plan. So that's the 2026 retirement contribution update. Let me know your thoughts in the comments about anything mentioned in this video. And go ahead and like this video and share it with someone who may need it. Subscribe to the channel. It truly helps. But like always, my name is Karan, and I'll see you in the next video. Take care.